The tuition bill just hit your email before lunch. It's your kid's first one, and it's bigger than what they had quoted you. And right now, every instinct says to pull it from your 401k. But don't. At least not yet. I've watched parents grab 50 grand from that account and quietly hand the market and the IRS 200,000 more for the exact same bill. There are 3 smarter ways to pay it. Let's protect your retirement without leaving your kid stranded. Here are the 3 moves. But first, see the trap clearly because most parents only catch half of it. You see, when you raid your retirement account to cover a bill, you think there's only one cost, the amount you pulled out, when in fact, there are 2. Pull $50,000 from your 401k and the first cost is the growth you're never going to see back. Because 50 grand today left alone for 15 years is close to 200,000 by the time you actually need it. And that money just doesn't leave. It takes your future with it. The second cost is quieter and almost no one connects it. Your 401k balance doesn't count against you on the FAFSA, but the money you pull out of it does. It becomes income, and the FAFSA reads your income. So the withdrawal you just made to pay this year's bill can raise what the formula expects you to pay and shrink the aid your kid qualifies for 2 years from now. So you'd be paying twice to solve one problem. So here's the one rule before we start. We pay this bill without dismantling the engine that pays for the rest of your life. I'm Tim Gardner. Move 1, the cash flow audit. Now before you touch any account, you run the audit. You'd be surprised how often the money is already there, just sitting in the wrong place. Start with what most people miss. Because when your kid leaves home, you're spending shifts. The grocery bill drops. The travel teams, the lessons, the activities that ate $200 or more a month for a decade. That money didn't vanish. It just lost its job. We call that found money. So now you redirect it at the bill before you borrow a cent. Next, call the bursar. That's the billing office, not the financial aid office, because those are 2 different people and 2 very different conversations. Ask them one question. Do you have a payment plan? Most schools do. It splits the semester into monthly pieces, maybe a small fee and usually no interest. That alone can turn a wall into a slope. Still short? Now we borrow. And there's an order to it. The federal direct student loan is first, in your kid's name, not in yours. It's $5,500 the freshman year, and a little bit more each year after that, $27,000 over the 4 years. And the only thing it takes to qualify is the FAFSA. No credit check. You see, a lot of parents skip this and go straight to the Parent Plus loan because the school drops it right into the offer. You got to be careful there, because under the new law, starting here in July, the Parent Plus is capped $27,000 a year, $65,000 over the student's lifetime, 9% rate of interest, and a fee on top of that. You borrow $20,000 at that rate, and you're paying back closer to $25,000. Start to see the order now? Found money, payment plan, student's own loan. Then we move to the taxable accounts, then maybe a HELOC, then Roth contributions if you truly need them. The 401k is dead last, and it's usually never called. Hey, if you're not sure which account to tap first, that's exactly what the Wealth Clarified score sorts out for you. It's free, a 10-minute assessment, links in the description. It'll show you the gaps before they become a 2 a.m. problem. And about that 401k loan some of you are thinking about right now, the one where you pay yourself back, there are 2 catches. You pay it with after-tax dollars, and then you get taxed again when you retire. So the same money is taxed twice. Don't forget, if you lose that job before it's repaid, the balance comes due in a hurry, and what's left turns into a taxed, penalized withdrawal. I had a parent tell me once she pulled from her 401k for tuition because she hadn't done the best job in planning that year's cash flow, and then had to take out a student loan anyway the next year. That withdrawal didn't fix the problem. It just added another one. That's the audit. 2 more moves. And the last one is the one almost nobody knows they're allowed to take. So stay with me. Move 2. The family move. Grandparents often want to help, and assume helping will hurt your kid's chance for aid. For years it could. That's changed. On today's FAFSA, money a grandparent gives, including from a grandparent-owned 529, no longer gets reported as student's income. So, a grandparent who wants to help can now do it without quietly costing your kid aid. There are two ways to do this cleanly. First, the grandparent can pay the school directly. It is exempt from gift tax, no limit, no gift tax form. It never touches your accounts and never lands on your bill as income. Second, that leftover 529, the one that everybody worries about overfunding, can now roll into a Roth IRA for the kid for up to $35,000 over their lifetime. So the money you set aside for college that didn't get all used up becomes the start of their retirement. One rule if you got a 529. The IRS runs on a tax year, not on a school year. The year you pull the money has to match the year you pay the expense. So if you pull in December and pay in January, you've just made a clean distribution look like a problem. As always, keep a paper trail. Keep them the same calendar year, and don't drain the entire account at once. Hey, you've got 4 years and 8 bills ahead of you, so spread it out. Move 3, this is the one I promised you. And seriously, it's the one that parents don't realize they're allowed to make. Remember, you filled the FAFSA out months ago based on an old tax year. But as we all know, life's moved on. Maybe your hours got cut. Maybe your job changed. Maybe a medical bill that landed that the form never saw. Here's what most people don't realize. That aid number, it's not final. You can appeal it. It's called a professional judgment or a special circumstances appeal. You write the financial aid office, you explain plainly what changed, attach proof, and ask for them to look again. They have the authority to adjust it. Hey, they can't help you with a situation they don't know about. So the parents who do speak up are the ones who get a second look. And this is where move 3 ties back to number 1. If you drained your 401k to cover the bill, you may have just raised the income on the very return the appeal is based on. So you'd be walking in asking for more aid while the withdrawal argues a very different situation. Protect the engine and you protect the appeal. So that's the audit, the family move, and the appeal. 3 ways to pay the same bill, and none of those run through your retirement. And here's the part I want you to actually hear. Protecting your retirement is not choosing yourself over your kid. It's you refusing to become the bill they have to pay 20 years from now. No loans exist for your retirement. There's no financial aid office, there's no appeal. You are the whole plan. And funding their future by dismantling yours just moves that problem down the hall to the same kid. Hey, I've spent 3 decades doing this for a living. I've also put 2.5 kids through college myself. My youngest starts her junior year. That's how we end up with half a kid through college. And I've run these exact numbers at my own kitchen table, and I will tell you, an imperfect framework beats no plan every single time. So run the audit. Make those calls. And if you want a clearer read on where you stand, the Wealth Clarified score is right there in the description. 10 minutes, no statements, no personal information. And if this hits close to home, that's exactly what we do for our clients. And we're taking on new clients right now. So come by, say hello. Now, managing the bill that's in front of you today is only half the battle. If you want to make sure you aren't just paying for this semester, but actually protecting your ability to retire on your own terms, you need to see the next video right up here. In it, I break down specific long-term traps parents fall into and how to avoid overpaying for the entire 4-year journey. I'm Tim Gardner, and I will see you in the next video.